Coming up in today's show, a judge rules Microsoft can buy Activision Blizzard, sending the stock up 11%. Billionaires and corporate executives have dumped $9 billion worth of stock this year. Bill Gross predicts American consumers will run out of money later this year. Fed officials are saying more rate hikes are needed. The market's pricing in a cooler than expected inflation print tomorrow. China's economy worse than most people realize. And some bullish breakouts across the market. Welcome back to the Click Capital Daily Show, everybody. My name's Jared, and I'm going to take you through all the latest data, news, and charts from the markets today. So hit that subscribe button if you haven't already, because I make these shows every day after close. And so today's price action was a bit of a continuation from yesterday, with mega cap tech still a little weak, and most of the rest of the market was pretty strong today, with a lot of bullish breadth across the board, except in healthcare there was a bit of weakness. And I think why we're seeing that is the market is pricing in a better than expected consumer price index data that we're expecting tomorrow morning. So the headline CPI is expected to come in at 3.1% year-over-year growth. The previous reading we got was 4%, and that's why we've got a bit of bullish breadth across the board now, with the S&P 500 pushing close to year-to-date highs, which are just above 4450, and we've got the broader indices breaking out more so as well. Here's the equal weight S&P 500. Breaking out above this resistance zone I'd been watching and on strong volume. Same with mid caps and the Russell 2000. Both breaking out to multi-month highs. And we've got the Nasdaq as well coiling up in this resistance zone. If I take you out to a weekly chart, almost looks like a bull flag on the weekly chart here, with this move up here and then coiling. And we are seeing that bullish seasonality that we often see in July appears to be playing out. And so the market looks like it's going to get a better than expected CPI number tomorrow. So if that was higher than 3.1%, that might upset the market a little bit. And if it came in lower than 3.1%, we should see a further rally. However, the movements in inflation is not completely linear. And you can see back here in the early 70s, we had inflation above 6%. It came down to the low 3s before it crept back up to 12% in the mid 70s. Then it came off again down to below 5%, then shot up again to 14% in 1980 before eventually coming back down. However, the way the stock market's going, it's expecting inflation to come all the way back down to 2% and stay down here like it had done for pretty much the last 30 years. But that might not stop the Fed from still hiking even further. We had two Fed officials say today that more hikes are needed. That was Cleveland Fed President Loretta Mester, who said rates need to move up somewhat further and be held at that level. And the other one was San Francisco Fed President Mary Daly, who said she was in favor of slowing the pace of tightening, but also realizing we're likely to need a couple more rate hikes over the course of this year to bring inflation down. She said the risk of doing too little outweighs the risk of doing too much, but that gap is getting narrower. And that's part of the reason why we've got billionaires like Bill Gross, who's predicting American consumers will run out of cash later this year, paving the way for a recession. He said the government's aggressive spending during the pandemic is still helping the economy. He said $4 trillion of COVID spending still dripping into the economy, with consumers still spending their last $500 billion or so. And Wharton professor Jeremy Siegel has a similar sentiment as that, saying the YOLO consumers are driving what could be one of the last good stretches for the economy. He said the you only live once consumer is out there traveling and enjoying the summer. And there's some truth to all that, because there is credit card interest rates at record highs, and more than 1/3 of Americans, 35%, say they are carrying their highest level of debt ever. And so currently credit card interest rates now average 20.55%, and the Fed's still not done hiking yet. So there probably is some truth to that. There is a lot of people out there enjoying their summer and throwing a lot of it onto the credit card and just going to forget about it until a later date. And possibly it could be all those reasons why we're seeing billionaires and corporate executives dumping $9 billion worth of stock this year. And funny enough, most of those sales have been concentrated in the tech sector amid Wall Street's frenzy over AI. Some of the biggest sales have come from the Walton family as part of Walmart, also Airbnb, Larry Ellison from Oracle, Salesforce, Moderna. However, you can look at all the other ones, Apple and NVDA, all the big names have had a lot of selling this year into this rally. And like it says here, insider buying in Wall Street has dropped to around half the levels reported last year. So corporate insiders and the billionaires, they're actually doing more selling than usual into this rally. And that's why we've got some analysts saying the S&P 500 is most likely going to correct back to 4,100, with them saying it isn't a bullish sign for the stock market that the Fed is still chasing an elusive soft landing. And they go on to say because the Fed's penciling in 2 or more potential rate hikes this year, as some elements of inflation remain sticky, the end result will be more damage on the economy than investors currently expect. With them also saying US stocks have been priced for a perfect soft landing, and however, like they say, the more the Fed hikes rates, the more likely that soft landing is not going to be achieved. However, there's still no shortage of bulls out there, including Fundstrat, who said inflation is about to show a big drop and investors should load up on stocks ahead of this week's CPI report. And in fact, Tom Lee from from Fundstrat said for the first time this year we are issuing a short-term tactical buy call on the S&P 500. They expect the index will surge more than 2% to above the 4,500 level, with the main catalyst being lower than expected inflation with the CPI report out tomorrow. We've got Q2 earnings season kicking off later this week with the banks getting things started on Thursday and Friday, and they'll give us a bit more of a look into the consumer. However, like those previous articles noted, that the consumer is still out there enjoying summer thanks to their credit cards. So earnings may indeed come in as expected or better than expected. Another news out today, Call of Duty game maker Activision Blizzard jumps 11% after a judge rules Microsoft can buy it. So the Federal Trade Commission FTC was trying to shut it down, which is going to be the largest tech merger in history with $69 billion purchase. And the FTC was arguing that it's going to limit competition and not be good for the consumer. However, Microsoft has fought back for some time now and successfully convinced the judge that it will actually enable competition rather than allow entrenched market leaders to continue to dominate. And so the market's convinced that's going to go through now. We can see that on the stock chart here today with a big move up on huge volume. We've got more worrying signs coming out of China with a former Chinese property mogul saying that China's economic downturn is more shocking than outsiders realize. And it's very unusual to hear someone like this speak out. He may be out of the country because if he's still inside China, he may go missing the next few days, as you're not really allowed to speak out and talk down the country in any way, shape or form, as a CCP's number one mandate is social stability. They don't want to lose their rule of power, and they need to keep everyone employed and happy and calm on the streets for that to happen. However, he said China's economic conditions are worse than thought. Even basic products won't sell as consumer prices near deflation. So this will result in tighter controls of the firms by Beijing as it becomes less secure. We saw that recently with the Chinese producer price index dropping by the fastest rate in 7 years. And the unemployment rate in young people is over 20%. And a lot of this is due to the deglobalization trend started after COVID. And that's because of their mishandling of the COVID situation. You know, things like blocking flights from Wuhan to the rest of the country while allowing flights from Wuhan to the rest of the world, and the big massive cover-up they did and not really taking responsibility for the situation is what's caused a significant withdrawal of international firms from out of China. So we could expect a big stimulus package to come out from the CCP to try and get underneath this thing, as it's not only the Western's withdrawal from China, it's also their big property bubble that popped over the last couple of years that has caused them a lot of problems as they overbuilt and created way too much capacity. So they've got a lot of empty cities and buildings out there. And just looking at a weekly chart of the China 50 index, still well off those highs it made in early 2021 and has not enjoyed the rally like the rest of the world stock market. And just going back down to the daily, the market doesn't seem to be getting too excited by the prospect of a stimulus package out of them. However, commodities may be, because China, as the biggest consumer of commodities in the world, any stimulus there should result in more purchase of commodities. And we got the commodity index jumping up 1.1% today, and crude oil as well continuing its short-term rally almost at 75 a barrel. Fed fund futures are still pricing in a near certainty the Fed will hike later on this month. However, this could change a bit tomorrow with CPI. It probably will come in as expected at around 3.1. If it did come in something different than 3.1, we'll probably move around the odds in the September contract a bit more. And whether we get a second additional hike, that'll probably change a bit tomorrow after the CPI, if it comes in higher or lower than expected. So we should still get at least one more hike. It's just the second hike is still up for debate. Fear and greed index still stuck in extreme greed zone, now approaching records for how long the market has stayed this technically overbought. Average day in the options market, 35.5 million contracts traded and a whopping 62% of them calls. Did see an unusually large amount of calls traded in Alibaba today. And just looking at the chart, Alibaba has been popping up a little bit these last few days, but just taking you out to a weekly, it's just been beaten down so hard ever since the CCP cracked down on Jack Ma and he went missing, and apparently he's now in Japan as a professor in a Tokyo university. And there's a look at the dark pool index representing the amount of buying done by dark pool traders, and they've pulled back significantly here today and still diverging from the market. So there's the S&P in the green line. And the amount of buying going on in dark pools continues to decrease. So like corporate insiders, they are selling into this strength in the market. Okay, back into the charts. We've got the TSX sitting right at the 50-day VWAP, but all the other international stock indices are still well underneath their 50-day VWAPs. As we've had a bit of softness in the markets in the last week or two. There's the VIX one day increasing today, pricing in the volatility we could get out of the CPI report tomorrow. But the main VIX 30-day index is still really depressed under 15. And all that call buying's resulting in an ultra low put call ratio in equities, 0.55, one of the lowest readings I've seen. As overall the market remains very bullish and optimistic here. Got the short-term breadth really elevated here at 82% of stocks above their 20-day average, and actually got a breakout in the amount of stocks above their long-term average, with 67% now above their 200-day average. 128 stocks made new highs on the NYSE today and 81 on the Nasdaq. So breadth continues to hold up and doing pretty well these last few weeks. Same with growth first defensive sectors, ticked up to a new year-to-day high today. High beta stocks still performing well, and a little bit of a pullback in growth first value. And there's the Russell versus a SPY continuing its bounce up from support, and there's inflation expectations pulling back a bit as well. So the market's really expecting CPI to come in tomorrow at 3.1% or even better. And that may be why we've seen a little bit of a pullback in the Fed sensitive 2-year government bond yield. We did get up to 5.11 last week, but we're at 4.88 today. But we've still got the back end of the curve with the December Fed Fund futures contract still holding up here at 5.40. So even though the market's expecting CPI to come in better than expected tomorrow, or in line, they're still expecting the Fed is not done hiking rates. Got high yield bonds back above their 50-day VWAP, but still not performing as well as stocks this year. So there's a bit of a divergence in the risky end of equities versus the risky end of bonds. Dollar continues to tick down now at 101.40 in this big support zone, and Bitcoin continues to consolidate just above $30,000 a coin here. Over to stock sectors, green across the board, all except for biotech, the only sector to come off a little bit here today. Defensive sectors were a little weak, except for utilities up 1.2%. The winner today was ARK with overvalued stocks up 3.7%, and also a good performing sector is the IPO ETF, breaking out to new year-to-date highs, and just showing there is some increasing demand for new equity coming into the market. Also having a good day was retail stocks popping up here, and with crude trending back up, that's sending energy stocks back up to a multi-month high. There's a look at BlackRock with earnings coming out in 3 days, and same with JP Morgan later this week. We're going to see earnings, and that's breaking out. Looks like it's turning this resistance line into support. Here's a look at mega cap tech with a bit of weakness in Apple. Looks like the wave flow might be starting to go red for the first time in a couple of months, and it just went red on Microsoft as we found slightly new lows today. I would have expected a bit more of a rally out of Microsoft after the judge paved the wheel for the Activision Blizzard deal to go through. However, it ended pretty much flat, so the market didn't seem too excited by that. The weakest of them all, Google, actually found new lows today but managed to finish a bit higher than it opened. Amazon looks like it's coiling up, starting to turn as well. NVDA continues to coil up in this really tight range here, and this could break out in either direction here. It's hard to say. There is a lot of momentum in the stock. We do have some bullish seasonality. I wouldn't be surprised if we break up to 450. However, we've also got these bearish divergences, so it could break down below as well. Tesla's having a little bit of a short-term pullback, but still in an uptrend. And the best performing of them all is Meta, finding new highs for the year as well today, as the market may be liking what they've been accomplishing with their new Threads app, as Zuck's copycat business model continues to work. Also weaker is AMD underneath its 50, and Netflix is just still holding up there, consolidating as well. Over to the meme space, some pretty good moves up here today, including Coinbase up almost 10% today. Saw another up day in Carvana, and even other beaten down stocks like Beyond Me and Peloton are all having a bit of an upswing, including Snapchat, which also broke out on volume. So Rivian just have a little bit of a pullback in these technically overbought levels, and SMCI finds new highs. And the banks continue to tick up into the earnings season starting later this week, with a lot of them coming out into next week as well. There's a look at our S&P 500 oscillator, currently at 56.4 and ticking back up, showing that sentiment in the stock market is still strong, and we can just see that in the price action of the S&P 500 and the equal weight as well, breaking out today, and the Nasdaq, which looks to be in a bullish continuation pattern. However, we do have these bearish divergences, so it seems technically the market's at a bit of a crossroads here. We do have this really good bullish momentum, some bullish seasonality, a bit of a bull flag forming on really low volatility, so it wouldn't be all that surprising to see a big clean breakup on the outside, especially if CPI came in lower than expected and the banks came out on Friday with really good earnings reports that could get the market going again. And so even though we've got a degrading macro backdrop with consumer debt, interest rates on the march, China's economy faltering and all that, that doesn't mean the stock market can't continue rallying throughout the summer until eventually that consumer spending dries up and everyone has to pay off their credit card. And then before we know it, the average credit card rate's at 22-23%. And we could have the 2-year government bond yield closer to 6% before the stock market wakes up to that reality. But until then, we've got a lot of strong price action momentum in the stock market, improving breadth as well. So we'd really need kind of a surprising vicious move on the downside to break all of that. And until then, I'm staying on the fence, keeping my portfolio market neutral, and we'll see what CPI comes in tomorrow morning and how the market reacts. But as it stands today, the market's expecting that CPI to come in line, if not better. That's all for today. Thanks very much for watching, and I hope to see you again tomorrow afternoon. Cheers.